So as discussed, we will cover in this lecture three and more assets portfolio, return on three assets portfolio, and the expected return on three assets portfolio, as well as standard deviation of three assets portfolio. We have already discussed two assets portfolio, that how can we calculate their returns, covariances, correlation, and finally portfolio standard deviation. Now moving to more than two stock portfolio, whether you work on three stocks or you take more assets, dynamics of portfolio making process will remain same. Means either you are taking three assets or you are planning to take four assets, only the calculation will extend, otherwise the things will remain same. Computation work will be very tedious when we move from two assets portfolio to three and more assets. Of course, on PPT, I'm not going to show you it's working, but giving you some basic idea that how it works, so that when we move to more advanced and simple conclusion, you can understand why we are changing this process. There is no doubt that as more assets you will add in portfolio, you will be able to diversify your risk and risk will gradually reduce. This is important to remember that whatever number of assets you are adding in portfolio return will remain based on weightage of your investment in different assets. So suppose you are investing in four assets, then portfolio return will be, as I'm showing you on this slide, as weightage you are giving to your investment plan. So if you look at this slide, you can see that we are making investment in four different assets. Their weights we have already calculated. And as you know that weights are depending how much fund you are investing in one particular assets compared to your total investment. Returns are given in front of each asset class. This of course should be given in the question. In last column, we multiply weight with returns and get its sum. This sum is showing that portfolio return is 10.6%. So this is our conclusion, that whether you are working on two assets or four assets or you are taking multiple of assets, the expected return will only based on the weightage and their returns of specific stocks. Now this slide is looking very complex, and of course the calculation itself is very complex. Expected return could be calculated easily as we did earlier, only probability will be required. But when you move to variance, if you carefully look at the formula of variance of three assets portfolio, you can feel that it requires many information. First, it requires returns, expected returns, and correlation between three assets. For your understanding, we will need correlation of all three set of assets. It means that we must calculate three calculation between various pair of assets. Of course, I'm not showing you calculation over here because calculation will remain in the online classes. Objective is just to tell you that if you simply working on portfolio based on correlation, calculation will become very difficult as you will increase number of securities in your portfolio. Now in this example, I took three assets, their returns and standard deviation, as well as weight of investment, as we have already calculated these things in the previous slide. And on this slide, I work to show you that if we have three assets, then we can calculate three correlation between pair, and then by applying the formula, we can calculate portfolio return and standard deviation.